All right, happy Friday. I am super excited for our topic today because Stacey is going to be joining us and we're going to be talking all about the red flags that you need to be looking out for when doing different types of investment strategies. She has had to learn the hard way and she is kind enough to come on and share everything that she has learned from her experiences. And honestly, I love this topic because I think one of the biggest fears and anxiety around real estate investing is not knowing how to protect yourself. And I think the best way that we can learn how to properly protect ourselves with different situations and different investment strategies is to learn from someone else's experiences. So she should be hopping on any moment now, but I am super excited. She's amazing. I had a phone call with her a few weeks ago when we were planning this, and I have pages and pages of notes. So make sure you guys have your notes ready, ready to go, because she's going to be spilling all the great tips and tricks she has. Let's see. I'm just gonna wait for her to hop on. Hey, McKenna. Oh my gosh, of course, my dog decides now to start playing with her toys. So if you hear squeaks in the background, that's what it is. Wait. So I am just waiting for Stacey to hop on. I'm gonna get my notes ready. We're going to be talking all about her experience with private money lending, with JV deals, with syndications, with all the red flags she's learned from just investing in her first couple properties. So I am very excited for her to hop on. Should just be another minute. I know, McKenna. McKenna says, I hate the awkward wait period for someone to come live with you. Yeah, and it sucks because I'm so nervous to like quit out of the video and then post it because I'm afraid it's gonna delete it. So I always have to post it right after it's done, so I can't edit it all, so everyone's gonna see this little waiting period. So, but thanks for hopping on. How many more days or weeks do you have until you go to Dallas, McKenna? Oh my gosh, my dog is literally in a box. She's climbing on a box right now. Taco, get down. Taco, down. Oh, there she is. All right, I'm gonna be adding you in, Stacey. Oh yay, a month from the day. Okay, I sent you a request, Stacey, so all you have to do is just accept it. Okay, I'm sending again. Okay. If the invite isn't working, what you can do is press the little camera button that has like a plus sign in the middle of it at the bottom of your screen. And then that will allow you to send me a request to join. Let's see if that works. Yay!
Hi.
Hello!
Yeah, I'm just going to have to join from my phone. I'm so sorry.
Oh, no, you're fine. That's what I do.
How?
Can you hear me?
Yeah, I thought it would work from the desktop, but apparently not.
You know what? Some people have tried that before on my other lives, and for some reason they had problems too. So I don't know why that's a problem. Yeah.
No.
But thank you.
Well, yes. Oh, hey, Jess. Thanks for joining.
Thanks so much for coming on today. I'm super excited for this discussion. I was just talking about right before you hopped on how I feel like the best way to learn how to protect ourselves is from other people's experiences. So I'm super happy you're able to come on and just share.
Yeah, thank you so much. And I'm sorry, I'm just going to get set up because I was not expecting to be this. So let me just get my phone set up so I don't have to hold it the whole time.
No problem. My dog is literally in a box. I need to go grab her. She decides now to just be trying to get in a box. Why? taco, stay. Stay.
Yeah. Okay.
Okay.
Good.
How's your day going so far?
Good. How is yours?
It's going good. I have to go to my W-2 job after this, so that's fun.
Bless you.
But so I don't know if you got my message on like I sent you a DM on Instagram.
Yeah.
Everything's great.
Yeah.
Okay.
Good.
Perfect. So do you want to tell us a little bit about how you first got started in real estate investing?
Yes. So when I moved to Colorado, I quit flight nursing and moved here so I could be closer to my family. And everybody told me that the pay here was horrible for healthcare workers. And I was like, oh, that's not going to apply to me. It sure did, though. Um, my income cut in half. And I was a very well established adult. So I was like, okay, this sucks. But luckily, I found real estate investing and started buying properties. I most specifically invested out of state because it's so expensive here. So my money went way farther. And then bought 4 duplexes in 18 months and invested in a syndication. And then that kind of brings us to the current time.
Oh my gosh, that's amazing. So going back a little bit to your very first property,
Yeah.
how was that experience?
Yeah, so it was lovely actually. I felt like the 2 years prior that I spent educating myself was way more stressful because it was that self-induced, like, what if? And you're always playing the worst case scenario.
Yeah.
That was way harder on me. So by the time I got over that fear, the first deal was like I had so much clarity. I was like, yes. It was like, oh, it was almost emotionless and thoughtless. Like I just knew that well at that point. So yeah, my first 3 were actually pretty seamless. But that's when the market started to shift and things changed.
Wow. And like looking back for your first 3, is there anything that you would have done differently or anything looking back that you would have changed?
Not on those, no.
Okay.
When I invested in the syndication, I don't regret it, but I just didn't, we don't know what you don't know. And I didn't even realize how green I was still at the time. So yeah, that's why I'm like super excited to share some of these red flags with other people. Because I like to talk about the hard things. So that can help set other people up for success. So you don't have to learn some of the hard lessons that I did just from not knowing.
Yeah. I mean, I feel like that's one of the biggest fears and anxiety people have with investing in real estate investing is just you don't know what you don't know, right? So you have to hop in and just hope for the best, but also still learn along the way. So I feel like that's why people like you are so valuable when you're willing to share these red flags. But going to the syndication, yeah, tell us about that.
Yes. So I would say one big thing is that I overly trusted people because they were in the same industry as me. So this is going to apply to all of our healthcare friends. This is going to apply to my military community. You never want to invest with someone just because they're the same thing that you are. Like if they're a doctor and you're like, oh my God, like I know them. I know what they had to go through to become a doctor. That's all great. But in real estate, it doesn't apply. And so I was like, should I go into it? I was like, not yet.
What?
I was like, should I start going into the actual like vetting process? Or are you just still asking generalized about my syndication?
Yeah, no, definitely go into it. We did have a question. Are there any specifics you can share about the syndication and what you wish you would have done differently?
Yeah, so that's all the tips that I'm going to share today. So yeah, I think the first big thing that people do wrong on their first syndication, and just to be clear, this is kind of like applicable for all various forms of real estate investing. So this applies if you're going into a partnership with somebody. This applies if you're going to do syndications, if you're going to do hard money loans, private money loans. Anytime you're working with other people in real estate specifically, these are the kind of things that you're going to want to ask. So I think the first biggest mistake is that people do the vetting in the wrong order. So they'll look at the deal and they'll be like, oh my God, this is a phenomenal deal. And then they tend to look past things with the managing partner or the operator. Those titles are all interchangeable, but they mean the same thing.
Mm-hmm.
And we never want to do that. So you should always vet the partner and the operator first, then the deal, and then the market, because we never want to get blinded by returns or things of that nature. And you could have the best deal ever and it could still fail because of the operator or because of a partner.
Mm-hmm.
It should just truly be the first consideration always.
Yeah, I love that. So you said, just so I have this written down correctly, you said bet the partner first and then the deal.
And then the market.
Got it.
And the market and the deal kind of happen simultaneously because this is another thing that people don't always like fully appreciate or understand. I think operators and managing partners and all of those people are not idolized, but they're looked at as like the sole expert or the subject matter expert, and they like shouldn't be questioned or something.
Mm-hmm.
You should absolutely try poking holes in their numbers, in the deal, and all of those things. So a perfect example of analyzing the market and the deal at the same time is you want to make sure that the comps that they're projecting, like rental comps or comparable sales if they're doing a rehab,
Mm-hmm.
you want to make sure that matches what's true for that market, because if it doesn't, then that's a major red flag and should be a high consideration of risk for you and your money.
Okay. And then what about the numbers? Like, because so you said you want to make sure the comps like aren't all the same, right?
No, so the things that we want to make sure aren't the same are the returns. Okay. So in specifically, this is more specific to commercial than residential deals. Underwriting it's a science. Like it's a whole thing. And so what happens is sometimes people get stuck in underwriting and they just use these same blanket numbers. And what that does is it causes your returns to look like they're going to be the same. So if you're looking at a track record of an operator and they have the same return metrics on all of their deals, first thing you want to look at is what was their projected on their last deal. It usually says their projected and then what their actual return was. So you want to look at how far off they were in their underwriting. But then you always want to consider that if somebody has the same return metrics on multiple deals, like more than 3, that would massive red flag that they're doing the same type of underwriting with the same exact numbers. Because real estate varies so much, it would be very unlikely for them to have the same result that many times in a row.
Right. Oh my gosh. And how did you find all of this out after the fact?
Through a hard lesson of things not going well in my syndication. Yeah. So, but yeah, I mean, it's still lovely to be able to help other people learn so that they don't have to lose their money. Yeah. But yeah, it's all hindsight, really.
Do you see yourself ever investing in another syndication?
Oh, absolutely. Yeah. They're a phenomenal vehicle. But my biggest mistake is that I didn't vet my operator. I trusted them by the proxy of my network. And so I looked at the deal and I was like, oh my God, this is so exciting. These returns are amazing. That's the one mistake that I won't make again. There are so many phenomenal operators out there. So just finding the one that meets your needs. Not only should they be somebody that you trust, but like maybe have some common values and shared mission. And then also considering the type of asset class. Different properties, like an apartment complex, might be held for 5 to 7 months, whereas a mobile home park might be held longer or shorter. So just aligning the type of investing that you're doing with what you want for your lifestyle is super important.
Okay. And what is there anything you could put in like in the operating agreement to help protect yourself, or anything you need to be looking out for that you don't want?
Yeah. So the operator or the manager of the syndication is the one that's going to generate the operating agreement. In a partnership, you guys will work on that collectively. So you definitely want to read through it and consider the types of things that you want in it. In a syndication, most specifically, things to pay attention for is, are there mandatory capital calls? which means that if something does go wrong in the investment, are you forced to continue to contribute more to save that property? Another thing is that I was like, what was the other big one first? Oh, voting rights and voting power. This is huge for partnership because you never want to have a legal stalemate is what they refer to it as. But in a syndication, you also want to understand like how is the voting power distributed? Because if your manager, the operator has all of the power to make decisions, then all of the people that put their money in the deal don't really have a say. If things do go south. So just like really understanding what your power and ability will be to contribute if there is something that goes wrong.
Is it a red flag when you don't have any power, or do some people prefer that?
Some people prefer it, and that's totally okay if you do. Again, just relying more heavily on the vetting of the operator and them as a person and their track record and all of those types of things. So totally fine, because that's honestly one of the best things about commercial is that you can leverage other people's experience and learn from them. And so that's a phenomenal way to get started. However, again, just spending a lot of time getting to know them as a person instead of just hopping right into a deal.
Yeah.
And I looked at you like almost like
what was that?
I said it should be just looked at like a marriage. Like you should never just jump like don't get married day one.
Right.
You get to know each other and see their values and conflict resolution. Like what happens when the deal goes south? Like how do they manage failure? I think people are, I don't want to say overly obsessed, but they focus too much on track record, which is great because you want to know that they've been successful, but a proven track record only looks at success. So having those hard conversations like, hey, have you failed, or what has that looked like when you made a mistake and how did you manage it? Because real estate is not, I don't know a single investor that has a perfect track record. Typically something has gone wrong in some way in some deal. So just like understanding how they manage that is really important.
Okay. And I feel like I always hear the saying, you want them to have skin in the game. Is there a certain ratio you look at to make sure that they have enough in the deal to where they're going to basically care about it? Or does that matter?
I mean, so it is different for everybody. Sometimes they do at least one of the the LP share, which is the passive investors. So it'd be like 50K or something to that effect. My biggest thing is that I always recommend that they don't have too much money in the deal. So if they have like multiple millions, first, that would be concerning to me because why weren't more people interested in this deal? But then second, it would make me personally make emotional decisions. Just understanding like how are they going to manage failure, or like sorry, I've had a cough recently. If like things start to get hard, are they going to be able to separate that from their own money with multiple millions on the line?
Is there anything that you need to be looking out for with how much like money they make with the what do you call it?
The asset fee?
Well, yes.
Yeah. So I would say the biggest thing with that is it's highly sought after to have an asset management fee paid out after the deal is successful. That makes sure that the operator is staying engaged and paying attention to your deal. And so just having the incentive on the backside, it just makes, it's like an extra layer of security or comfort.
And if they waive that.
If they waive it, definitely. I always say people shouldn't be working for free. Syndications, a lot of people think like, oh, it's so big, it's so easy, like they're professionals, whatever. They are a lot of work. And so if somebody waives their asset management fee, I personally would see that as a red flag because I'm like, why are they working for free here? Because that is a lot of hard work to do for sure.
And then how can you protect yourself with when you're wiring money or transferring money? Are there any red flags in that situation?
So I actually had this happen to me. So a bank, or I'm sorry, the title company sent me their wire information, and it was so sneaky. They're getting so good at this. It was, the email address was off by one letter. I think it was like an extra A or something. Like, it was insanely close. Like, I always expected scammers to have like horrendously different emails, or like, no, it was like to a T. And they were even using like the same bank, I think it was, but a different bank account. But anyways, the way to protect yourself is you always call to verify with somebody at the title company before ever sending any wires, because it's increasing a lot and you can never get that money back. Sometimes like it's super hard to prove and to fight that. So definitely being careful with that.
And does it matter who you're wiring the money to? Like, do you wire it to the individual or the LLC, or?
So it should always match. Well, so this is going to vary depending on the type of deal and everything. But if it's a syndication specifically, it should always match the actual asset or the deal that you're investing in. But now if you're doing like private money loans or hard money or partnership, it should always be to a real estate business account.
Okay.
So yeah, varying based on that type. I'm like, what are my other big things? A lot of people, if you don't mind me just saying this really quick, I think that in our day and age of social media, and I'm like gonna say this as somebody that has a social media account, people overly trust individuals with super large followings, or don't trust people with smaller followings. And I just want to say that just because there's like 50,000 people following somebody doesn't mean, because like I had somebody say like, oh, they have to be trustworthy if that many people follow them and like them. And I'm like, that, yes, it's a good point, but you should base an investment off of how many followers somebody has, because it's, you know, we control what we put on social media. So just definitely know them personally and have conversations with them individually. Don't invest with people just because they're like Instagram famous or things of that nature. Like, you should definitely still have hard conversations with them one-on-one to get to know them.
Yeah, absolutely. I love that, because I definitely feel like people get, I guess, like you said, too trustworthy, especially if they have a big following. I mean, if they have a big following, obviously it's like not that you can't trust them. It's just that don't lessen your due diligence any less just because they have a bigger following.
And I think another way of saying it too is that there's no correlation to how great somebody is at social media and how great they are at real estate. They're vastly different. So just like really accounting that somebody might be phenomenal and be like saying all the right things on social media, but are they able to actually put that to action in a real estate investment? And I'm not saying, you know, that there are people like pretending to be something they're not. I just want people to invest with somebody just because they have a large following is all.
Oh yeah, 100%. And I'm glad to say that, because I feel like social media nowadays too is such a big topic.
Yeah.
And it is a great way to build connections and relationships and to help kind of build up that trust. But as for the due diligence and the background period, that should never waver.
Yeah. It's like specifically too in commercial, like I know a lot of operators that are they don't want to have a social media because they just look at it like, I'm busy doing the work for the investment. And those are people that are worthy of considering to invest with because they are out there doing the work. So yeah, just not discrediting somebody or a deal or a syndication just because they have a big following.
Yeah, exactly. And it's like Jess said, the bigger the following, the less likely you'll be able to get a one-on-one. And for me, if I'm investing my money, I want to be able to talk to the operator if needed.
Yes, 100%.
And with the syndication, looking back, I know, was there any red flags like with reserves or anything that you like, any hard like statistics that you could have looked at ahead of time rather than retrospectively that other people can look out for?
So in addition, like we said earlier with those return metrics, anytime they match precisely, that should be a huge red flag. Understanding when you're looking at the deal, you should consider how much reserves they're putting away. I again expected like, oh, they're professionals, like they know what they need to do.
Mm-hmm.
You should always be double checking, never come into a deal with that thought process. Because if you like, reserves and underwriting are the two ways that you protect yourself in real estate. And underwriting is another word for analyzing in residential. So just paying a lot of time and attention to those two things. The reserve amount will change drastically based on how much work you need to do on the property, the age of the property, and then the size of the property. So that would be another huge one to look for.
Okay.
I'm going to look at my notes really quick because I had wrote another one. It's like, what? This isn't specific to the actual like analysis, but also understanding what kind of systems they have in place, because the finances of a deal are going to be huge to know the success or if you're like ever going off track. So understanding what their accounting process is going to be huge to know if there's problems coming up.
Okay. And when you can you give an example of like a type of problem that may come up that someone should look for?
Yeah, so like if you're rehabbing an entire apartment and then you have to turn that over to get this like new increased rent, understanding like the timeline. If they said that they're gonna rehab 50 units in 12 months, like on the dot, and there was like no window or like extra reserves to account if it had gone over 12 months.
Okay.
Like those types of things. So like the timeline, and then also delays of like getting things rented. So like higher vacancy, delays in supply materials. That was a huge thing during COVID because all of that got delayed. And so, I mean, you were just sitting waiting for months for refrigerators and things like that. So just making sure they have built-in extra cushions or exit strategies, things of that nature. Another huge thing to look for sure.
Wow. And I love that you said you can use all of this with multiple investment strategies, not just syndication, because it comes down to vetting also like private money lenders or doing other investors for like a JV deal.
Yeah.
Have you experienced a JV deal before?
So not like full blown. I did on my third duplex. I bought it cash and then had private money, a private money loan technically, for that acquisition, which is technically, I guess, considered a JV. But outside of that, I have been working towards getting into the commercial space in that more JV type deal.
Okay. And how was your experience with the private money lender?
Oh, phenomenal. Yeah, it was such a good experience, and I was like so happy with myself because I returned the money in 66 days and I had plan A, B, C, D. Yeah, those are the kinds of things that you want to look for. And then also understanding specifically to private money, how is your money secured? Because if you're investing in a deal and or giving private money to a deal and your money is tied to that specific deal, is much higher risk than if they'll collateralize it against something that's stabilized or something to that effect. So again, like understanding how your money is secured, what their multiple backup plans are to get your money back, and things of that nature are all good questions to ask.
Okay. And those are the questions that you asked the private money lender versus
Yep.
What kind of questions did they ask you when they were vetting you?
My numbers. So they wanted my analysis. They checked my comps. And then again, all those different plans, A, B, C, and D, poking holes in that. So my plan A that ended up working was that I pulled a HELOC to then pay the investors back. But if that didn't happen, then I was going to cash out refi and pay them back at 6 months because there's a seasoning period. And if that didn't happen, I had other plans. So just understanding like what that does to the timeline of you getting your money back, and then what the risk is. I was closing on that HELOC right when the lending market and everything was like changing and getting way tighter and interest rates were going up. So they literally told me that my HELOC was one of the last to close. And so again, like accounting for the fact that your money is tied up and you have agreed to give that to somebody, And so if they don't make that first timeline, are you comfortable with the other timelines? And then the additional risk or whatever else comes with that.
Yeah.
But yeah.
Wow. That's amazing. I love that you had such a good experience though. You're 66 days. I mean, that's impressive.
Really started the paperwork before I'd even closed on the property. Like I was, and it, it was also, I take it as a massive blessing that I've actually lost money because, I've always had an appreciation for not losing my own money, of course.
Mhm.
But I think that people, when you start to like scale and you're working with other people's money or partners or things of that nature, if somebody hasn't lost money, like it's you can say all day that you like appreciate it, but until you've lost someone else's money, like the feeling and the impact is just so much greater. So I'm grateful that I've actually lost my own because I take it absolutely so seriously. And if I ever do bring in my other people's money into my deal, like I vet with all of these red flags for my investors before
Yeah.
ever even considering asking somebody else to put their own risk and money into those things. So also asking those types of questions to people that you're going to partner with and work with.
No, I love that. I love that you're using your experiences in a positive way to prevent it from happening, not only just for you, but from other people willing to invest with you.
Yes.
And also coming on here, and then this will hopefully help others like avoid those types of
Yeah.
experiences as well. I mean, it's so important to just share and teach and not only learn, but just to keep spreading it.
Yeah. And I do have a few more that I would love to share with the
Oh,
audience.
yes.
So another thing is that, and then going back, because I know people are going to be like, you just contradicted yourself. Because I said, a track record is super important, but look at their failure. But another thing is that you should always look at an operator or partnerships, look at their performance over the size of their portfolio. I think a lot of people get blinded by the size. And so somebody will be like, oh, I have 80 million assets under management or like whatever the number is or 500 doors, and they're like, oh my god, that's so amazing.
Yeah.
But generating returns, like somebody can have 500 doors and they're not performing. So looking at their historical performance over getting blinded by the size of things is another huge one. um, and then So yeah, like I said, the big thing too with the conflict management and how important it is to have those like hard conversations and questions of handling failure. Another big reason that is because real estate investing can be super timely. So like if you make one isolated mistake, it seems fine. But then if you make another, it becomes like dominoes, and then the whole thing can just like tip over. So another question to ask is like, how do you take this? Like, how do you escalate it? Who do you have looking over you? Do you have a mentor? Do you have other partners? So kind of understanding how decisions are made. So you're not just like a sitting duck waiting and then things blow up. Because with those timely decisions, the more time you wait, the less options you have. So it typically restricts those exit strategies or things that can help or pivots that can save things. So just like really understanding the way that they do that. And I guess said like a different way, I want to say it was AJ Osborne that said it at a conference I was at. But he said the most dangerous things he's ever seen in real estate is somebody with pride and greed, and especially if they have both. And that is because the scaling to these like massive portfolios with that greed, and then being too prideful to admit fault or failures or mistakes. And so they try to cover it up or try to fix it even on their own, even if they're not covering it up. It still limits the ability and the power of real estate is like the network and the community. So not being afraid to ask for that help and lean on others is huge for so many reasons.
And I feel like that resonates because you said something earlier about if they start raising money before the deal is even over, that's a red flag because that's almost like they're trying to cover up or raise money for something that the investors are unaware of.
Yeah, and well, I think another thing too is if they're already raising money for another deal, you need to ask questions like, do you have a team in place to stabilize your property that you invested in? Or do they have the systems in place? Or how are they going to manage that? Because when you start rapidly acquiring properties, things compound really quickly, both the good and the bad. Your returns will compound, but then also issues can. So making sure they have that team and system in place to be able to manage that. Everything is getting the time and attention that it deserves.
Okay. So raising money for other deals is fine during your project as long as the teams and systems are in place.
Yeah, there are multiple super large syndicators that do that because they're just having so many deals come their way that it's, I don't want to say it's effortless, but it is almost like effortless. Like they're just such a well-oiled machine. So totally expect it in those types of situations. But again, they have that team in place to be able to manage multiple projects at once. So kind of understanding that. And then two, if they're in multiple markets, like making sure that there is a team built in each one. So they're not like figuring it out as you go.
Previously for the mentor, did you, through all learning all of this, did you have like a mentor or coach that you were able to ask questions to?
I am just part of a military investing community that I have been so grateful for the people that are in it, because I could just ask them questions and understand. So they would like point things out or, hey, this is what I would have done or this is what I would have looked at. I've been able to learn so much from them. So definitely that power of networking in real estate and just always like appreciating somebody else's opinion because it might not make sense yet, but they like when you're in a different situation, their advice or their perspective might apply. So like kind of like having those different options in different ways of people to talk to and ask questions to is huge. For sure.
Community is so important, and I'm so grateful that now more than ever we have more resources available and more communities than ever. I feel like, because I feel like communities are such a big thing right now that people are creating, and I love it. And it's just creating more opportunities for us to go out there and be a part of. And I feel like that's gonna like add a lot of protection for us in the future through harder situations, because we're gonna feel like have more communities now that like other investors like you started out earlier like didn't have back then.
Yeah.
It's crazy.
Yes, absolutely.
And for your, let's see, I had another question and then I just forgot about it. I had a brain fart. And what would you say, looking back on all of this, is the number one most important question that you should be asking another investor that you're looking into going to under a deal with?
The number one thing, I mean, outside of the deal, I want to know what their communication style is like. Because again, it's like a marriage. And so how they're going to handle that conflict and be able to communicate with you, and are they going to hide it or can they be forthcoming? Yeah. And then with the deal specifically, like understanding how they got the numbers they have in their underwriting or analyzing. And then also like asking like what kind of debt are they getting? That was another huge thing that I never thought to ask previously because I was like, oh, again, they're the professional, they'll secure whatever. No, it massively changes the amount of risk in a deal. So yeah, asking, you have the ability to ask anything. I think that's like an overarching blanket statement is that you can have the best deal, but with a bad partner, it can still fail. So just really understanding that you guys have those aligned interests and goals is huge.
Oh yeah. Gosh, I'm writing that down. I love that you just said that. The best deal, but with a bad partner can still fail. And can you give an example of like what you just said with the debt? That's like, can you give like an example of that?
Yeah. Specifically in commercial this year, it's super common to get a bridge loan in commercial when you're doing rehab, which just means you secure it's like a shorter term loan. to do construction, and then you get into a more secure loan after. But it's very common in commercial that investing that your loans are only for 3 to 5 years. And so you have to understand that they've underwrote for a different interest rate at that 3 to 5 year mark if they're planning to hold the asset beyond that. So kind of looking at like, did we account for a interest rate to double? Because that's the current issue, that nobody expected interest rates to spike this fast and this high. So just looking at that, looking at how long the loan is secured for, even looking at the lender is a big deal right now because commercial loans are kept on a bank's books. At least that's my understanding. And so it puts a bank at a lot more risk to have non-performing loans. So are you investing, or is your loan with like a Bank of America or like a big secure bank that has other income to offset the risk of the commercial loans, or is it a smaller lender that could go under because of non-performing loans? Because that's going to change the relationship with them and what they act like when you miss a payment or if something goes wrong with the loan. So just like really understanding the dynamics of how powerful the loan is and what can happen because of it.
Yeah, and it really surprised me too when you told me that thing about the HELOCs. With that with a bank, is having troubles right now, especially in the commercial world. They could call it due.
Yeah, and I do think that's like for pretty much any type of loan. HELOCs in particular, though, are like any line of credit, whether it's business or on a real estate asset, like anything of that. The line of credit, if it's non-performing and or there's something that the bank doesn't like or they're over leveraged, that's from my understanding the first place they're going to go to get their money back, to get more of that security blanket for themselves.
Yeah, they don't really come out and tell you that
Yeah.
like openly, like, oh, by the way, worst case
Yeah.
scenario.
Yeah, it's definitely something that like it should just be respected with like a healthy amount of appreciation, that it is meant, a lot of, especially HELOCs on homes, they're meant to be more temporary. So not using them as the loan for the property for the entire duration. So yeah, I was like, they're for home improvement and things of that nature. So just like appreciating the true intention of the loan type, very important.
Crazy. Oh my gosh. Like, you should see. And this is on top of all the notes we've already taken. Did you have anything else on your notes tab that you wanted to share? Let me just turn the page.
Oh my God, I love you. So yeah, again, just like really understanding the type or the amount of reserves. Again, I just want to really hit on that. And then going into the market, I know I like briefly touched on that you're going to look at the market like to make sure the comps are right or that their rental assumptions are right. But another like super high level thing to consider is where we're at in the investing market cycle. So not so much like the geographic location of the asset, but like right now, this year specifically, is a very rocky part of the investment cycle. So I would use a ton of caution getting into a large investment right now, but then also considering operators and people in the past 3 years, or even 5, I guess it is. I don't want to say it's been easy, but it was the easiest part of the investment cycle, because interest rates were super low. You can make a lot of things work when the interest rates are in your favor. So like understanding that, because it was not something that I had considered, of like, it's easy to look good on paper. And this is even myself, like, let me be clear. All of my investments have been in the past 3 years. And I think I underappreciated until the current time where I'm like struggling to find good deals and things of that nature. Like, man, it was really just that much easier because of where we were at in the market investment cycle. So yeah, just like really appreciating some of those factors is going to be huge.
And for like the reserves, is there like a calculation or like what any type of number that people can just, I guess, give like a vague look at, like, oh, like is it, do you want to look at double the amount in a certain investment versus you want to triple the amount in another investment?
So
That's a vague calculation people can look at.
they're vastly different, even from residential to commercial. A lot of people typically, I think it was actually Brandon Turner in some of his initial Bigger Pockets thing, would always do like 6% for CapEx and then 6% for repairs and maintenance, which shows like both of those types of reserve things.
Mm-hmm.
But if it was an older property, he would go up to like 8%. Right. So that's kind of common for residential side, but for commercial, you're typically looking at economies of scale. So it needs to reflect according to the size of the building, in addition to the amount of work and in addition to that age of the property. So I don't know that there's a fixed percentage, but because like if you're rehabbing 500 units versus 50, going to be vastly different. And you also don't, when you get those economies of scale, you don't always have to have, so like for instance, if you're doing a 50 unit and you want to have like 20,000 per door or something for rehab and all of the factors, you don't necessarily need that on a 500 unit because they do them in segments and then rent. And so then they have this like constant, they're securing the risk by fixing so many, getting them rented, and then moving on in the project. So kind of analyzing what their game plan is or business plan is for the investment, the strategy of it is vastly going to change the entire percent. So no fixed percent that I can speak to, but
commercial is just a whole other monster. I've only been looking at residential, but I definitely want to get into commercial. So I love all of this.
Well, you absolutely will.
When you switched from residential to commercial, like what was your mindset going into that? Were you intimidated or were you ready to just tackle it?
Oh, I was totally scared. Are you kidding? I was scared. It's so funny to like watch the growth pattern in real estate because like you start investing and you're like, oh my God, I'm so scared. These people are so smart and I don't know anything. And then you get comfortable in that. And then I started.
Oh, I can't hear you. I don't know why it does that. If you got a call, oh wait, I think I hear you now.
Are we good? Okay. Then I started going to commercial conferences to like start learning and just like get in the room and be around these people.
Yeah.
And I was like so scared all over again. And I was like, oh man, just when you thought you got there, the fear starts all over. But yeah, it's just all part of growth. And my biggest thing for people is to understand like we all deserve to be in this room, whatever room that is. So just like appreciate other people's intelligence and what they've learned, but then also like you get to learn that too. So never let anybody tell you that you are not welcome somewhere, you don't know enough. Like, no, you will learn it. And the best place to learn it is by being with those people.
Can I just like cut that part out and like put it on my wall or something? Just daily motivation right there.
Yeah. It is. It's so terrifying, let me tell you. And I had my duplexes and I'm like going to commercial conferences where people have like one building, the 10 sizes bigger than my doors. Yeah, it can be terrifying for sure. But yeah, just take up space and let them know that you're there to learn. There's no shame in that.
I love that. Thank you for that. I think that's something right now, like in like my investment area too. I just needed to hear.
Yes,
because sometimes you just feel bad for taking up space if like you don't have that much to give, and so it's like trying to get over that mindset.
I honestly, like, I look at real estate investing as a vehicle to get us to where we want to go. And I think everybody deserves to have that vehicle. And so that's why I give everybody permission. If somebody is being a gatekeeper about their knowledge or their access to conference or whatever, just know those aren't your people and find who your people are in real estate, because this information should be shared for everybody to access for sure.
Should be like a motivational speaker.
You're Fine.
Or write a book. Something. Well, thank you so much. I just wanted to double check. Do you have any other notes that you have?
One last thing. As you're getting to know people, both in partnerships or in investing in syndications or whatever strategy you're going to go with, I always recommend to do one trial. So like get one asset with them and see how it goes. Do an investment into a syndication and see how it goes. Never put all of your eggs in one basket. So like never put $150,000 with one syndicator. Definitely just like try it and then wait a year and then choose, do you want to reinvest? Did that work for you? Did it provide the returns you wanted? Was the partnership healthy?
Yeah.
Kind of like analyzing those things before moving on or doing more, because putting all of your eggs in one basket is a sure way, is a lot of risk. So I would highly recommend against that.
Yeah. And when you're partnering with someone or doing a syndication, how often do you meet with them?
So with my group specifically, we were meeting once a week. But yeah, if you're an investor in a syndication, it's again going to depend on your business plan, but I would say at least once a quarter you want to be hearing from them. And then maybe even monthly if you're doing like massive rehab projects. And then definitely video calls so you can ask questions and like really get into the details of how things are going and the returns and the numbers. What is their accounting showing? So yeah, I don't know the cadence of big syndicators video calls, but I would say it's probably once a quarter until stabilized.
Okay. It's good to write that down on my second page of notes. Well, thank you so much for coming on. I seriously I can't thank you enough for just sharing all of this. And I really do hope one day you write a book or put on a conference or something, because you just motivated me so much and made me feel so much better about this whole investing world, because it can be very intimidating sometimes. And I love people like you that are just so willing to share and just like have the biggest vehicle that you're just saying, everyone just jump in.
Yeah, because I really believe in the power of people, right? And like I have learned so much from other people and their mistakes. So I just hope to provide the same. So thank you so much for that very nice compliment.
Well, thank you so much. And if anyone wants to, I'm sure, most of these are your followers. But if anyone wants to find her on Instagram, you can find her at Invest for Freedom RN. And thank you again for coming on and taking the time just to talk to all of us about this.
Thank you so much for having me.
All right. Have a good day.
Bye.